Alright, how's it going guys? Welcome to the first video on my channel. Now, some of you might recognize my voice or may even have my socials from the Spectre Trading YouTube channel. So going forward, this is where I'm going to be posting my own videos and yeah, we'll be taking it from there. So in today's video, I'm going to be covering my one shot one kill model for completely free. Now, this is the whole approach and the whole model that I use when I know that I'm not going to be active on the charts for the week. Perhaps, I'm busy or occupied with some other things going on in my life, so I can't really attend the charts. That's when I will default to this model. Anyways, with that being said, let's look at the model, right? So the whole point of the model is to hunt one high probable trade per week, usually per pair as well, right? And that's going to be in the direction of the likely weekly expansion. So if I have a bullish bias on the weekly candle, I'm going to be hunting one very high probable long setup for that week. So it is an intra-week model. We're looking to hold the trade between 1 and 4 days, and it's very stress-free, right? It's the perfect model to trade if you're trying to balance work or education, whether you're studying or in school or whatnot, alongside your trading. This is the perfect model for you if that sounds like you, right? If you're someone that doesn't have much time to stay on the charts, or perhaps even if you just want a more relaxed and stress-free approach to the charts. Okay, so moving forward, let's look at the checklist, right? So there's just four key components. It's very simple stuff. So the first thing is we need a weekly candle bias. Is the next weekly candle going to print bullish or bearish? Once we understand that, we can determine a likely profile based on PD arrays, right? Now, once we've pretty much sieve that out. We are now looking for the low or the high of the week to be set, followed by an hourly displacement. Now, to keep things simple, when I mention hourly displacement, I'm looking for energetic price move, creating a fair value gap. You may define displacement differently, or you may just view it in a totally different way, and that's completely fine. Whatever works for you, you don't have to follow this model to a T. Make your own refinements and make it fit your personality, right? But me personally, when I'm referring to displacement, I'm talking about energetic movements creating fair value gaps. And finally, we want a minimum of 2 or being offered, right? We need a nice positive risk to reward ratio. Great. Now that we understand that, let's have a look at profiling. So to keep things simple, I've split up the weekly profiles into three. So we have the consolidation reversal, in which case we would use an AMD framework. We have the classic expansion, in which case we would use a market maker model. And we have a midweek reversal, in which case we would also use a market maker model. Now, if you aren't too familiar with these concepts, don't worry, I will touch on this in later videos. But for now, let's just focus on the market maker model profiles. So, in a classic expansion week, we reference price outside of the weekly range, and in a midweek reversal, we reference price within the weekly range. Now, personally, the midweek reversal is my favorite profile to trade. It's very simple, and I'm going to explain to you why in the next slides. So, with all of that being said, let's go into the charts and find a nice example. All right, so here we are. Let's keep things nice and simple, right? This is the weekly time frame. As you can see, we have run sell side liquidity to the left, creating a long-term low, followed by displacement to the upside, creating a fair value gap. Upon reaching the fair value gap, price gives us another displacement leg higher, running buy side liquidity. At this point, price retraces into this new fair value gap, creating a swing point on the weekly time frame. Now, if you look at the previous weekly candle, being this one, we are going to trade the next weekly candle, right? But what has the previous one done? It has traded into a bullish PD array, being an inversion volume imbalance. So as we can see on this week, price trades through this volume imbalance, invalidating it, whilst also creating a swing point in the market. Now the next week opens, we trade lower into that old PD array and we reject with a large wick to the downside. Now, if we look to the left, we have buy side liquidity as a target. All right, so using all of these confluences and painting a very clear narrative, you have to ask yourself, is the next weekly candle likely to trade bullish or bearish? Now, simply being put, it's very obvious that it should trade bullish, right? Overall, we're in an uptrend. We have that discounted PD array and we have a clear rejection supporting higher prices. Great. Now that we understand that our bias on the weekly candle is bullish, let's hop onto the daily chart and see what happens. So here we are on the daily chart, And just before we get into this, I want to clarify this is the current week we should be trading in, right? So this is the Monday, this is the Tuesday, this is the Wednesday, and this is the Thursday of that weekly candle. So if we look to the left, we have two forms of buy side liquidity, and we also have this low hanging fruit here, which is also a form of buy side liquidity, right? Now, if we mark out our dealing range from range low to range high, this is a discount. What we can see is that the weekly candle opens and we immediately trade lower. We trade lower to run into a discount, right? We run a swing low in the discount of the market into an old volume imbalance. Now, why is this level significant? Look what it done. Price trades into it and we get a sell off, right? This level, which was previously used as resistance, then gets traded through and then we use it as a level of support to potentially trade higher, right? So what have we done so far? We've depicted a weekly bias. Our daily time frame now aligns with that daily bias because we have a valid PD array trading in the discount of a dealing range. So how do we get involved? Let's go into the hourly chart and let's look for our checklist, right? So far we have the weekly bias and this is the hourly chart. So you can see Monday opens and we trade lower all the way into Wednesday. Now coming into Thursday, what do we get? We get that hourly displacement following a potential low of the week. That is what we look for in our criteria, right? We're looking for the low of the week to be set, followed by an hourly displacement. Now, I just want to clear a few things up. So this black line is the sell side liquidity pool that we had on the higher time frame, and this is a market maker buy model, right? This profile is the midweek reversal because the reversal happens after Wednesday sets the low of the week. So with the midweek reversal pattern, what I said is we reference data within the current weekly range. So notice how we are only targeting Monday's high at the extremist, right? We can also target any of these highs to the left, but what we are not doing is targeting price action to the left, external to this range. So now that all of that is clarified and we have our checklist, where do we get involved? So here we are, and this is the first entry available. So again, following that hourly displacement, once the fair value gap is created, you are simply setting a buy limit order on the open of the fair value gap with your stop loss at the swing low, and you are targeting anything above 2R. Now, the most obvious draw on liquidity that gives us at least 2R is this swing high to the left. Anything before this level does not give you 2R, which is why I've gone for this level, right? Furthermore, if you wanted to swing even higher, you can, right? You can swing it to Monday's high. But me personally, I'm more of a passive trader, right? I'm not aggressive with my targets. So I'd be looking to take profits as soon as we're up around 2 to 3R. And if you did miss that entry, that's completely fine because there's another opportunity available, right? So if we follow this, you can see what then happens is the next day, being Friday, we get a run on sell side liquidity into this hourly fair value gap, followed by a change in state of delivery, right? So we validate this order block. This becomes a valid order block, following a run on sell side liquidity into a hourly PD array, which is also in line with our longer term draw on liquidity and our weekly candle bias. So this is your second opportunity for an entry if you missed the initial entry down here, or if you just want to be aggressive and get another trade. And very simply put, that's how it would look like, right? Simply entry at the open of the order block, stop loss beneath the strong low. This becomes a protected low since it ran sell side liquidity to the left, and it's also the order block low, right? We're not expecting price to trade beneath this. Entry at the open and TP at the longer term high. Now, this trade specifically, you would have had to hold through the weekend. So that's literally down to your risk appetite, whether you want to hold trades through the weekend or not. Me personally, it's not something I would do. But if you are a longer term trader, I'm sure you're used to doing things like this. So it's completely normal. Anyways, with all of that being said, that is how you approach my one shot one kill model, and those are two very high probable entries for this scenario. If you did find this video useful, I would really appreciate it if you could like and subscribe, potentially leave a comment if there was anything unclear or anything you would like me to clarify. You can find my socials down below in the description, and you can also join the free Discord, which you will find on my Twitter, right? And I'm more than happy to help people for free on there. Thank you for watching, and I'll catch you guys in the next one.